Welcome to Rydon Academia. Today we are going to be looking at the final account of a sole trader. Now the final account refers to the account that a sole trader prepared after the business year has ended, like at the end of the business year. Okay, so that's what a final account is. Now in accounting, after we have prepared our subsidiary books, we prepare the ledger, right, and then we'll move to the trial balance. You'll be seeing our videos. If you've not watched them, please do well to do so. Okay, now after the trial balance, a sole proprietor, which is a one-man business, okay, a sole proprietor has to do with just one person that owns the business. He contributes capital, he takes control, he manages the business, okay, and he shares the profit and loss of the business. He alone is liable for that. All right, now the final account, after we have prepared the trial balance, like I said, then we'll move on to preparing the final account. That is, this account are prepared at the end of the trading period. Okay, now the final account is basically for a sole proprietor. We just have two final accounts. All right, the first we have is the statement of comprehensive income, and then the next we have is the statement of financial position. Alright, so these are the two accounts literally that constitute the final account of a sole proprietor. Okay, now we're going to be looking at the statement of comprehensive income. The statement of comprehensive income is used to help us know the gross profit as well as the net profit. Okay, it shows the gross profit and the net profit of a business during a particular year. Now what we do is that we try to compare all the possible expenses. Now when we are talking about the trading account, in this case we are going to be looking at the trading account and the profit and loss account. All right, now we try to compare all the possible expenses that arises, both the direct and the indirect expenses. Okay, and then we deduct them from the available income that was generated during that particular year to know if we made a profit or a loss. Okay, and that can now help the business in making decisions, okay, on how to make adjustments for better performance in their next year. Right, now the statement of comprehensive income is divided into, literally it has three branches, anyway, three divisions. Okay, we have the trading account, we have the profit or loss account, and then lastly we have other comprehensive income. All right, now these are the three basic divisions we have. So we have the trading account, we have the profit and loss account, and other comprehensive income. Okay, now for the sake of this video, I'm only going to be touching these two, that's the trading account and then the profit and loss account. All right, now the trading account, which we'll be looking at in this video, the trading account help us to determine our gross profit. All right, our gross profit, it is called gross because other expenses have not been deducted. Now gross profit, okay, gross profit is a type of profit where only direct expenses were deducted. When we are talking about a trading account, all right, the direct expenses now has to do with the expenses that was directly involved in trading, like in the purchases of goods, in bringing the goods to the shop, as well as maybe paying a worker or whoever it is, a laborer or a worker that was directly involved in selling. So when we less direct expenses from the sales, in this case just our net sales, okay, if there was a returns inward. All right, when we less our direct expenses, the sum total of our direct expenses on trade, okay, we less them from the sales, what we arrive at is our gross profit. Okay, that's why it is called a trading account. It only reviews the gross profit. So quickly, what I'm going to be doing is I'm going to be showing us the format of the trading account in this session. In the next video, we'll be looking at the profit and loss account, and then thereafter we'll be looking at the comprehensive income. That means I'll be merging them together, okay, for better understanding. So this is the format of a trading account. Okay, now the first thing we always do is the name of the business. Okay, the name of the business, let's just say XYZ Limited. Okay, the name of the business. Then the next thing will be the name of the account. All right. Now the name of the account in this case is the trading okay. This is how it is always addressed. All right, we address the account, trading account, for the year ended. All right, because it's always prepared at the end of the year. Right, now we have, in preparing our account, we have the vertical and the horizontal method. All right, so I'm going to be using the vertical method. Okay, and in the vertical method, what we do is we consider our income first. We consider our income first before we consider our expenses. All right, since we hope to make a profit, we bring in our income first. Now our income in this case include our sales. Literally our major source of income is sales, right? So when we get our sales value, and then in some cases there may be returns back to the business, what we call returns inward. Okay, now returns inward is a terminology used to describe goods that were sold. Okay, the business has sold these goods to customers, and then for some reasons these goods were returned back to the business. Right, so after the business makes sales, they enter into their sales book. Right, now when these goods are returned back to the business, they have to open the returns inward book. All right, so this is the total of the returns inward from the ledger is posted here. Okay, and then we less. Now when we are saying less, we use our bracket, okay, to symbolize subtraction. So we let's assume we are using our x for figure. Right, we are going to less our returns inward. All right, and then when we less that, we'll be having our net sales on the second line. Right, we'll be calling this our net sales. So this is the total amount of money that was gotten from sales for the particular year. Okay, now the next one we're going to be looking at, we have considered our income. Right, in the trading account we're going to be considering only our direct expenses. Like I said, direct expenses meaning they were incurred directly on trade, on those goods that were being sold. All right, now the first direct expenses, when we start looking at the cost incurred in purchasing goods, the cost incurred in bringing the goods to the shop or the business venue. Right, as well as the cost incurred when we pay a direct worker, a worker that was involved in the direct selling or indirect carrying of the goods. All right, now the first thing we look at is our opening stock. Now our opening stock, this refers to the goods that is available in the business at the beginning of the year. That is, these goods were available in the business as the year started. All right, so it is called opening stock, goods available. So we consider the value of those goods. All right, let me be bringing in the third naira sign. Right, now we consider the value of those goods that were available at the beginning of the year. Right, and then if there was any purchases made, like I said, purchases refers to goods that was bought only for resale. All right, that terminology, purchases, is only used for goods that was bought for resale. If an asset was bought, it is not termed purchases. If any other thing was bought that is not for resale, it is not termed purchases. Only when the business buy its goods for resale, all right, that's when we call it what? Purchases. Okay, now so the goods that was bought by the business will also be taken into account. Right, and then if there was any carriage, now we call it carriage inwards. Right, that's the expense. It's a direct expenses. It's incurred in bringing the purchased goods, right, to the business venue. Okay, it can include maybe the transportation cost, right, for bringing those goods to the shop, as well as if there was any offloaders, right, that helped in bringing. Okay, so they are all termed under what? Carriage inwards, and that's a direct expenses. So we're going to be adding that to our purchases because that expenses was incurred because of those goods were purchased. Okay, so we'll be adding that to our direct to our purchases. Right, and then we're going to be lessening returns outward. Okay, now we less returns inward from sales. Right, then in the same way we're going to be lessening returns outward from purchases. Now returns outward means that we as a business has bought these goods. Okay, we bought these goods from the supplier and we have brought it to the shop. Now on checking or inspecting these goods, we found out some defects, we found out some errors, or maybe they were not up to the standard we wanted. okay, some were damaged in transit. There can be many reasons why goods are returned out. But after the business owner, all right, saw that these goods were not fit to his own taste, okay, he had to return them back to the supplier. All right, so we are going to be lessening that from what we previously purchased, okay. So there's a separate account called the returns outward account, and then at the end of the period, right, we are going to be moving the balance to the final account, okay, to know the net purchases. So we are going to be lessening that. Now, after we have added our purchases and carried inward, right, so we're going to be lessening our return. Like I said, whenever we're lessing, we use our bracket, right? So we're going to be lessening our returns outward, and then whatever figure we are having left, okay, from this, we're going to be bringing it. This figure is called our net purchases, right? Okay, so this is what we call our net purchases. Now, when we bring in our net purchases, we will now add it to the value of our opening stock, okay. These goods were already in the shop at the beginning of the year, so no expenses whatsoever was made on them, right? But on the purchased goods this year, expenses was made on them, goods were returned out of them, okay. So when we have made that adjustment for purchases, we now add our net purchases to the opening stock value, okay. What we are going to be having is what we call the cost of goods available during the year. The cost of goods available for sale. All right, this is the total. When we add this, that is during that year these goods were available for sale, okay. So that's what we call it, literally the cost of goods available for sale. So I'm going to be using AFS, okay, to represent available for sale, okay. Now, when we have gotten the cost of goods available for sale, these goods were available. That means if anybody comes to the business to buy these goods, they were available to be sold, all right. But the truth is that not all the goods will be sold, okay. Not all the products that you have will be sold. At the end of the period, some will be left, like the remnant, all right. We call them the closing stock. So at the end of the business year, those goods that were not sold, although they are available to be sold but they were not sold, we term them the closing stock, all right. And now if those goods were not sold, it means the other part that was not in the shop was sold, right. So when we less our closing stock from our cost of goods available for sale, we less it, right, from our cost of goods available for sale, what we then have is the cost of goods that was actually sold, okay. It means those goods were sold, all right. The unsold part, when we less the unsold part of the goods available from the total goods that was available, the balance we are having is the goods that was actually sold, okay. So we call them the cost of goods, the cost of goods sold. Okay, now what we do is when we get to our cost of goods sold, okay, when we get to our cost of goods sold, like I said, what we are lessening here is every direct cost. Direct costs include direct materials like our purchases, right. We have direct labor and we have direct expenses. So if there was any direct labor, let's say the salary of a direct worker, a wages, okay, of a direct worker, somebody who was directly involved in this case in trading, because it's a trading account, right. So a direct expense has to do with trade, okay. Now if any worker, the wages of a worker who was directly involved in trade, in the trade in activity of the business, if we have such a worker, because a direct worker receive wages, literally every direct worker, direct laborer, they receive wages, okay. So if we have such, all right, in the case where we have direct wages, we also add that to the cost of goods sold, right. So when we add our direct wages, what we are going to be having is the cost of sales. It's called the cost of sales, okay. So we're going to be moving our cost of sales to the third line to meet our net sales. Like I said, in our trading account, we consider all the direct expenses, like what we just did here. We consider all our direct expenses and then we less them from sales. We less them from sales, then what we'll be having is our gross profit, okay. So like I said, this is what we call the cost of sales. Let me make a little adjustment. So we call that the cost of sales, all right. That is for this one. This is our cost of sales. And when we less this, so when we are using less, I'm going to be bringing in our bracket again, okay. Now to make it possible, all right, let me be adding. So we're going to be having a double X, right. So when we less our cost of sales, what we are going to be having All right, the X now is representing our money figures. Okay, what we're going to be having as a balance is what we call our gross profit. Okay, so this is the format for just the trading account. Okay, now what we're going to be doing next is we're going to be taking a equation, right, and then we'll be applying this format. Like I said, this is the format. This is how we follow it step by step. All right, so we're going to be applying this format, and then we'll be moving on to the next topic. All right, now let's see. We're given that the trial balance of Jonah, okay, the trial balance of Jonah and Sons Enterprise as at 31st December 2015. Okay, we're given his trial balance. So we're going to be using this trial balance to prepare just the trading account. All right, like I said, this video is just for trading accounts. So we're looking at we have gotten sales of 37,200 naira. That's our sales is 37,200 naira. All right, now the next thing we have purchases of 23,112 naira. Okay, this is our purchases value. Now we have inventory, that's the opening inventory. Like before I even forget, yes, in our trial balance, whatever value of inventory we see in our trial balance is the opening inventory. Okay, it's something to note that in our trial balance, what we see there is always the opening inventory. That's the opening stock or inventory. Stock and inventory means goods. Okay, the opening inventory is the only inventory that is reviewed in the trial balance. Whenever we say closing inventory, it comes outside the trial balance. It is not reflected in our trial balance. Okay, so that's the rule. So whatever we see inventory in the trial balance, what we are saying is our opening inventory. Okay, now so opening inventory was 7,552 naira. So our opening stock, this is our opening stock. We have carriage inwards. All right, our carriage inwards to be 468 naira. We'll be entering our carriage 468 naira. All right, now we have returns outward. Returns outward was 710 naira. Okay, now we have returns inward, and our returns inward was 880 naira. So this is our information. Returns inward, naira. Now, like I said, outside the trial balance, right? Outside the trial balance, we'll be seeing information on the closing stock. That is outside the trial balance. So we are giving that closing stock at the end of the period. That is at the end of the trading business year, right? The closing stock is 9,996 naira. So our closing stock for the year 9,996 naira. So this is the information that was given to us, and we are asked to prepare a trading account. All right, we're going to be using this information. Like what I said is we have to follow this format. All right, we don't try to do it any other way. We follow the format. Okay, so we're going to be entering now our sales value. I'll just be erasing this quickly so that it will be easier. All right, so we're going to be using the information given, right? As you can see, we have used that information to prepare a trading account. All right, we just used the same format, right? Then we made entries for sales as it was given, and then we left our returns inward, right, to get our net sales. And then we have our opening stock where we adjusted for purchases, right, where we have our carriage inwards and then our returns outward to give us our net purchases. So when we add our net purchases and our opening stock, we have the cost of goods available for sale, right? And then we less our closing stock to get our cost of goods sold. All right, so when we less our cost of goods sold from our net sales, like this is our direct cost of goods sold, right? We less our cost of goods sold from our net sales, we'll be having our gross profit. That's the major disclosure in the trading account. Okay, we're able to get our gross profit. Now with this information on the gross profit, we'll be using this to prepare the profit and loss account. All right, from with the gross profit, now we can prepare the profit and loss account, which we'll be doing in our next video. So don't forget to like this video, subscribe to our channel if you haven't, click our notification button so that when new videos drop, you'll be notified immediately. Share this video with as many as you can, and also leave your thoughts in the comment section. We'll see you in our next class. Thank you.